Thanks, Jim, for doing all this work for me.
Who's it? All right. And we've got 3 chairs. Stop. Nice to meet you. You want to sit in the middle? You look much better than I do.
Whatever doesn't make a difference. Which here on the left?
Full. Yeah. So you're sitting over there. Yeah. I'm gonna stand up here. Okay. I'm gonna stand up there.
You have more white hair. Good.
First. Experience.
Well, good afternoon, everyone. Welcome to today's panel. Debt deals in demand, real estate investing beyond 2025. My name is Jim Bowles. I have 30 years experience in the asset management field, primarily on the new business and relationship management side. Most recently, I spent 3 years at Prana Investments, a firm focused on rent stabilized multifamily, and prior to that, over 20 years at Common Fund, a nonprofit asset management shop. So we've heard some about real estate today, and as the landscape for real estate investments continues to shift, investors face a mix of challenges and fresh possibilities. With refinancing pressures looming, sector winners and laggards separating, and capital constraints reshaping deals, family offices must adapt quickly to assess value and manage risk. So today's panel brings together industry leaders with experience across cycles and sectors, ready to share practical insights in which strategies for most long-term success. So I'll introduce the panelists. I'll start with Paul Sygrove. Paul is a chief investment officer at Swig Equities, a privately held real estate investment development firm with deep roots in New York City real estate. Thanks for being here, Paul. We have Aaron Manosherry. Aaron is the CEO and co-founder of Manacherry Brothers. It's a third-generation family office focused on value-added multifamily real estate. He leads the firm's operations and growth strategy across key U.S. markets.
Let's see if we can.
Assaf is here. Assaf Leman. Assaf is partner with Churchook Partners, a hospitality and alternative real estate investment platform. He focuses on sourcing and executing investments in hotel, extended stay, and niche lodging assets. Churchook has built a reputation for creative deal making and operational execution there. So we also have on the line, we have Steve and Schiff. Steve, he's the founder and managing partner of Performance Advisory Group, a real estate advisory and investment firm known for navigating complex financing and structuring situations. And he advises investors and operators on recapitalizations, restructurings, and value-added opportunities across property types. So thank you all for joining us today. I'm going to ask you all to spend a couple of minutes on your background. So why don't we start with you, Paul?
Paul Sygrove, born and bred in the north of England, been in New York for 35 years. It's been an unbelievable ride. I've worked at real estate companies called Helms Spear, which is one of the 4 places of going to syndication. I then went to NYU Stern for an MBA, worked for a couple of investment banks, and then I ended up working at Swig Equities, Kent Swig, third generation of Swig family out of San Francisco.
Thanks.
Good afternoon. This works.
It's on green. All right.
You should go.
Aaron Manucherry. Thank you, Marty. Again, great seeing you. We're a third generation family in the business of real estate. Originally on my father's side from Iran, came over in the 70s after the Shah fell, and really rebuilt everything from scratch. And that goes to my elders. My brothers and I am one of 8 kids to my generation. So I work alongside of 3 of my brothers. And our focus is multifamily apartment buildings in top tier markets. So we have around 6,000 or so apartments, valued at a little over $2 billion in AUM between California, New Jersey, Florida, with a separate portfolio in the Middle East. Latest focus is Florida. A lot has changed between economics, politics, war, and many other things in between that caused me to get up and leave Los Angeles and move out to here and Florida. We can get into that shortly, but it's a pleasure being here.
Hi, Assaf Leman, married 18 years. I've got 3 wonderful kids. My background is on Wall Street. I worked at a large hedge fund for about 15 years as a portfolio manager. Then took my ball and chain and went to do better things. Private equity is my own private capital. I founded Churchook Partners with 2 partners, and we've been buying all kinds of different real estate, really focusing on the affordable housing crisis across the country, backing in through extended stay hotels, converting extended stay hotels into multifamily, or reimagining what SFR could look like in the future. So really excited to be here. Great panelist, and I'll turn over to Stephen.
Steve?
Hey, thank you for having me, Marty. Once again, it's a pleasure to see you. Stephen Schiff, I've been in the commercial real estate investment space for about 32 years. I started as a very young vice president with Bank of America back in the early 90s, eventually went on to run all their distressed commercial real estate assets, both the hard assets as well as the debt. I took that and I launched it into a career basically managing large investment platforms, multi-billion-dollar platforms, but mostly, look, my nickname is the fixer. Like, they bring me in when there's a challenge, and so we've turned around assets, we've turned around companies. Today, we're doing 3 things really. We're doing direct investment in distressed real estate. We're advising our clients where they're facing a short-term maturity or they've got negative leverage. And lastly, we're teaching people how to jump into the game of investing in distressed commercial real estate, because frankly, we think we're looking at generational opportunities. So once again, guys, thanks for having me. It's a pleasure to be here. I wish I could be live, by the way. That looks fun.
Well, great. Well, thanks. We have some questions. Let's start with talking about a lot of loans that are coming due over the next few years. So Aaron, family offices also often think long-term. How are you preparing the portfolio for the wave of loans coming due over the next few years? How do you evaluate the opportunities versus the risks?
Sure. Great question. I would say most of our loans are minimal LTV, around 55, 60% LTV max. Most of them in line with the 10-year T-bill. So it was really during COVID that we saw many new players come into the world of real estate. Majority of them taking 5-year notes, 90% LTV. And that ship has sailed, with many today who have found themselves decapitated from over-leveraging deals in order to make cap rates work. Now, for us today, we're not really pressured being forced to refinance. We recently refinanced a little over 150 million in loans, but we did that at 5% with a buy down. Now we're waiting for, I think we're in a great position. The 10-year T-bill, to my memory, is about 4.3%, give or take, down 40 plus bips, which is fantastic. It's music to our ears. And I think that between the political realm in New York City, relative to Mamdani, along with all the movement we're seeing into red states, especially the state of Florida, cap rates continue to compress. And with the new job report out in August at 22,000 jobs, I believe it is, down from 75, we do believe that we're going to see something. The question is when. So I think with patient capital and less leverage, you're not really forced to do anything drastic. And it's about sticking to your principles during these times, especially.
Thanks. So Paul, New York owners face the same refinancing pressures. How are you and your team managing that risk while spotting new deals?
Not too different from Aaron. Most of our buildings are all long-term loans, and those loans are very well taken care of for the next unforeseeable future. Just before COVID, we did a complete capitalization of the complete portfolio. Therefore, we're fine for the next several years. Yeah, it was luck more than anything else, quite frankly. But so we're in very good shape for the moment. Most of the buildings are Class A, so we don't have the issues of low occupancy. Most of the buildings have high occupancy, particularly in New York City, where the office market, commercial office building is on fire for Class A. So we've been able to achieve high occupancy and low leverage and low loan to value. Thank you.
Steve, you've advised clients through multiple credit cycles. How do you see the lenders behaving in this refinancing wave, and what strategy should owners consider to stay ahead of the curve?
Yeah, no, that's a really interesting question. I sat on a few panels about a month ago those panels were at a special servicing conference here in Dana Point. I'm from beautiful Southern California, and the game has changed, as most of you guys know. The intent behind lenders and servicers, primarily over the last 2 years. Now, of course, there's exceptions to this rule, but has been to play along, right, and to do short-term extensions, try and pull a little skin and get a little bit more skin in the game from an investor side. So maybe a principal pay down, etc. But there's been a definitive willingness to work with the borrowers. The consistent message shared a month ago, and the biggest players were there. All of the largest special servicers and lenders were there. The message is today, the gloves are coming off, guys. Many of them see some additional pain that we're going to experience in the world of commercial real estate, particularly in the multifamily side, where we've got just extraordinary numbers of debt coming due over the next 1.5 trillion over the next 18 months. So we're seeing much more aggressive lender maneuvers, whether it's appointment of a receiver or the starting of foreclosure. The gloves are starting to come off. They're being much more proactive in terms of enforcing their rights. And it's going to change the game, guys. It's going to change the game in a very real world. Just high level, my perspective is, and this has been proven over the last 3, now 4 downturns that I've been in a senior executive role. Bottoms don't really get installed in any valuation scenario until there is forced selling. And we have thus far in this cycle, and we're not technically even really in a recession, are we? So thus far in this cycle, we have seen limited forced sales. That number, or that percentage of overall transactions, is definitively going to increase. At least that's the messaging that I got. So to answer your question, how does it relate to borrowers, and how do they posture themselves? Look, it's all about capital. It's all about managing the underlying asset to optimize performance and valuation, and then early and consistent communication. Look, the loan's maturing, lender has maturing, they have rights and remedies. They will pursue those remedies unless you bring them a reasonable alternative. So yeah, it's a matter of being upfront, well capitalized, like some of you gentlemen are, and being clear and transparent. Early, consistent communications.
Right. Thanks, Steve. Assaf, hospitality assets were hit hard during the pandemic. How do you approach refinancing risk in that sector today, and where do you still see lenders leaning in?
Yeah. So like what the other panelists said, I think at the end of the day, it's basis, right? You can absorb high leverage, low leverage if your basis is good. And in the hospitality space, because people buy it in the wrong times of the cycle, it's incumbent on you to find the opportunity where the basis is low enough that everything can go wrong and you can still make money. And the pandemic, which is where we ended up starting our journey in the company, is buying post-pandemic extended stay because it was most resilient in the economy, right? It's multi-light. And so we target, similar to what the other strategies are, long duration stays where we have predictability on our revenues and we can control our expenses. If you buy at the right basis, you last through the cycle. If you over lever or you start thinking, something that's B is going to turn into A, you're going to get slammed in the face when the cycle doesn't work in your favor. If it's a B, it's a B. And if it's an A, it's an A. And if it's a C, it's a C. But just underwriting and being thoughtful and transparent with both your lenders and your capital partners on what the thesis is and not having thesis drift, that's what keeps you alive through cycles.
Are you doing major improvements on your B properties to make them more of an A? I mean, like, for example, if you buy them at so discount prices, you can afford to take a floor out and give amenities as a Class A office building and still make a substantial return.
So we're super diligent on underwriting. If it's not doing a 30% return on our invested capital, it's just not worth doing. I'd rather delever the property and wait for the cycle to turn where cap rates compress significantly across the board, and then take that opportunity to either reinvest in the property or divest it. If taking out a floor makes sense, because it's going to have a high return, then sure. But oftentimes what we find is the best use of our capital and time is working with the municipality of converting those hotels into multifamily and achieving that cap rate compression that way. Investing in a B class property makes a lot more money as a multi than investing in a B class hotel.
Sure.
Great. So moving to distressed or opportunity. So Paul, from an operator's seat, what makes a potential capital partner stand out to owners in tough markets like today's?
Oh, that's a good question. We've had some partners. I think knowing them well is the most important thing. Be able to sit down with them and talk about everything and nothing. Have many dinners, many drinks, get to know them before you get into bed with them. More and more, it's just not about, the dollars. It's about the personalities, what they've done before, and their reputations.
Thank you. Relationship. So Steve, you often sit at the intersection of investors and capital providers. Where do you see the most compelling opportunities in distressed or traditional deals?
Yeah, no, another good question. Thank you, Jim. I tend to gravitate towards those assets that have been oversold. And today, as we know, well, let's look at San Francisco office buildings as a prime example. In 2019, San Francisco office assets were the blue chip in the CRE space. And now today, you can't get rid of, you can't give them away, literally, although that market does frankly seem to be changing. So when I think about investment and opportunities, I tend to seek out those that are either oversold or, in the case of multifamily, frankly overbought. It was mentioned earlier on the panel that there was a lot of sponsors with zero track record, limited liquidity that jumped into the multifamily space between 2020 and 2023. And that ludicrous investment cycle where virtually anybody could be investing in multifamily if they had a pro forma that made any sort of logical sense. And so that is an asset class across the country, frankly, that was just frankly overbought. And though that it's largely bridge debt that looked a lot like subprime debt back in 2006, 7, and 8, is maturing. And a big chunk of those 1.5 trillion in maturities over the next 18 months is in that multifamily space. So the right investment, underwritten fairly well, and getting to this notion of who's the right capital partner. The right capital partner is very liquid and nimble and can move quickly. So look, when we talk about investing in an unknown market, which is frankly where we're at today, we don't know what the next 12 months is going to hold for us. But my perception and my belief as a chief investment officer is your greatest hedge is just to buy extremely well. And you do that with distressed assets, whether you're buying the note or the asset, restructuring and assuming the debt, or just buying it outright.
Thanks, Steve. Hotels often change hands in distress. What signals do you look at for a property that's truly a turnaround opportunity versus a value trap?
Yeah, that's a great question. When we view value trap as just trying to clip the right coupon and hoping that the CMBS market shows up to bail you out of your bridge debt. I mean, any hotel is the highest speculative risk asset other than land. And when you're taking bridge, you're on a clock. And if you don't have a real business plan to get out of that bridge, you're dead. So what we look for specifically on distressed opportunities in the hospitality space is it convertible, right? Can I buy something at 20 cents on the dollar and get the rezoning done and it's worth 5x, 10x that? Because then I have Fannie, Freddie, HUD available all day, every day to take me out. If it's a hotel, can I turn around the operations enough where I can improve the revenue profile? Because hotels are a little bit different. How they get traded is more on revenue multiples than it is on underlying operating income. Is there a path to get the revenue up that a true buyer, natural buyer, an owner operator can take over that property? Those are very hard to come by. Hotels are a very fragmented market. There's generally a reason why there's a hotel's distress that's been underinvested in, and that's a significant amount of capital. we've found most success buying from public companies who are selling not because there's a distressed reason, but they have a they just want out of the business.
Public companies, are they programmatic in the way they sell? Like, we don't just go to Duke or IvyFON or Sweet Spot.
Yeah. Oftentimes you'll find most public companies want to own 15 years or less vintage properties, right? There's just less deferred maintenance. There's less R&M that has to go on. Our sweet spot is buying those older vintage assets where there's a unique value proposition to the customer. It's usually a larger format, also easily convertible to multifamily. And those generally fall by the wayside because there's not a natural buyer of that property.
Do you invest in those properties? As far as capital improvements?
Yeah, so generally our capital improvement plans across those properties are basically you would find in multifamily. We're investing in flooring, paint, ensuring that the life safety systems are functional. But what we drive a lot of the value is, if you stay at a Holiday Inn Express for $100 and it's 200 square feet, we can give you a 350 or 400 square feet unit with a kitchen in it for $80, and we'll compete on price because our basis is low enough that we can undercut our competition.
Is there a trend in the hotel space where, could you see there's whole pockets where there's 5 or 10 hotels right around each other, right? Where you go to some place out in Nashville, Tennessee, or Nashville, North Carolina, somewhere, right? And do those ever fall out of favor? And then it's easier for you to pick up those sorts of assets. Would you ever pick up more than one of those assets in a location?
Sure. So the problem with hotels is everybody chases after because they think it's the easiest thing to do, and it costs very little to build, right? You need 2 acres and you put up sticks and bricks, and generally the municipalities like it because it's occupancy tax and that helps them pay for whatever it is they want. You end up getting oversaturation in a lot of places. We have a very maniacal focus just on extended stay because the optionality around having a kitchen and catering to a different type of customer is very important to us. When you think about traveling doctors or traveling nurses or somebody who has a life event, they want to stay in a place where it feels like home, even if it's not home, rather than trying to catch that incremental shopper who's, in Nashville for the night for some concert, and that's how I'm going to make money. That's a very volatile business model. You're very cyclically oriented, and COVID can come and take away a lot of your business. Or if there's no Taylor Swift concert in that market, you're comping really bad. Where we focus on is durability of our revenue, and that allows us to optimize our cost structure, which drives sustained, durable NOI margins.
So it's purely cosmetic.
Purely cosmetic.
Right. Aaron, where do you see family offices stepping in when other owners are under pressure?
Well, recently, I think to everyone's point on this panel, we've gotten a lot of phone calls on many younger groups that have come into the picture in 2020. And I met a lot of these guys at conferences, and they were boasting about how much they bought, looking at me like I was crazy that I didn't buy. And I kept explaining to many of them that, it's nice that you just bought 1,000 units or 1,500 units, but please break down your capital stack. And many of these younger groups would just boast to us about how they're over levered and how they're paying a 3 cap or a 4 cap in a market that should be a 6 cap or 5.5 cap. And that's because the Fed funds rate at the time plummeted in order to artificially infuse cash to the economy. And it went up, since then about 11 times and down 1 point. So even at 4.33 today, to the point of 1.5 trillion in distressed debt, there's about 250 billion of that in multifamily. So us being patient and not living that FOMO lifestyle, as some people put it, has proved to be very profitable. We're negotiating on a few deals right now in our backyard in the West Palm Beach area. Friends of mine that bought it during COVID, and will be stepping in, and they're going to be losing probably $10 million on it, and their equity is being wiped out. And that's simply because we waited and they didn't. They have 10, 12 fees in each deal. We have 2 fees, maybe 3. And our mindset is not focused on the IRR metric. It's really, what's my basis? how much am I making on this buy at closing? And we'll only buy 1 to 3 portfolios per year, sometimes nothing. That's okay. It's about when you pull the trigger at the perfect moment and not caving on your principles. So for family offices today and like-minded individuals, there's great opportunities out there right now, which we continue to sift.
Thank you. Okay, so winners and losers by property type. Steve, let's go to you. You work across sectors. Where do you see the clear winners and losers among property types over the next 18 to 24 months?
Yeah, I guess it really depends. Another good question, by the way, Jim. I think it depends on where you're sitting. If you're a buyer, that answer is going to be different than if you're an existing owner. We know that the majority of the distress today sits in multifamily, which, by the way, is a first. At least it is for me. Multifamily has always been sort of the treasured asset class, right, of the space, but that's not necessarily the case today. I think multifamily delinquencies, at least on the securitized debt side, are at all-time highs, and there's no indication that's going to turn around anytime soon. So I'll answer that question as a potential buyer. Because I don't think, by the way, we've ever seen commercial real estate so bifurcated in terms of desirability and accessibility. The distinction between Class A office in San Francisco and a data center is massive, and you really can't compare the two, despite the fact that they're generically speaking in the same asset class. So the winners, if you're an investor, I think the winners are clearly going to be multifamily and office. Office in particular, as I mentioned earlier, that the notion of I can't give away office buildings in San Francisco is shifting. And now we're starting to see some investment in that space. I think 10 years down the road, once we've got this sorted out, people are going to look back at this opportunity and say, my God, that was an opportunity of a lifetime, assuming that you invest well. And that's always a huge highline caveat. So for me, I follow where the distress is. That's where you tend to buy at deep discounts to both intrinsic value and historical trade prices. So sorry, long answer short is multifamily and office is where we're primarily focused, simply because that's where the greatest challenges are. Challenges to us mean great opportunity.
Great, thanks. So Assaf, beyond hotels, Churchook has explored some niche real estate plays. What specialty segments look resilient right now?
Yeah, so to the same point that Steve was making, I think it's also really important for investors to really focus on the operators. I mean, you got like 3 world-class operators here, and it's not buying distressed, it's giving the capital to the operator who knows how to operate the distress. And so people who can last through cycles and have a long-term mentality, you need that combination of opportunity, but actually an operator to deliver on that opportunity. That's where you're really going to get alpha. Otherwise, just give your money to Blackstone and, you know, they'll do whatever Blackstone does. What we think is really a generational shift is on the single family home side. One of the things that we're doing to address the affordability crisis is we don't have a housing crisis, we have a units crisis. If you can drive actual unit price down for individuals, where instead of a studio apartment like Atlanta costing $1,500, we're able to create co-living platforms where as a member, you're paying $500 to $700 for a shared living environment, and taking the friction away of what most people, let's say on the Upper East Side or Upper West Side, if you were 4 people in banking and you all lived in a 1-bedroom apartment and you put up walls and you have to figure out your roommates and who's going to pay what electric bill and heating bill. We've developed an in-house platform to provide that type of level of service where somebody as a member comes in, they get their unit, all of their bills are taken care of, they pay once a week, and similar to an extended stay model, but just on a shared living. Because I think ultimately most people are moving away from owning their own homes. I think we're becoming a much more shared renter society, especially the younger generation. I don't think there's as much ownership or cachet in owning homes, and those stranded assets in single family, I think it's going to be a generational opportunity over the next 10 years.
So shared in a single family,
shared in a single family home. Yep.
He's spot on. I want to add to his point. The average age 10 years ago of first time home buyers, I believe it was around 29 or 30. Today it's around 38, 39. So, and then on top of that metric, the average price to service a 30-year fixed mortgage with utilities all in today is around 3,500 to 3,800 on average, and that to rent is right around 1,800 or so. So you have a 40% delta ownership versus renting. And you have this new mindset in the US today, this is more relative to politics and whatnot, depending on what state you're in, where people just, at least younger generation, doesn't work like the elders used to. It's a different energy. And that's having a huge impact between education and just work ethic in general. So I think we definitely have our elders to look up to on how they came from where they came from to build businesses. And sounds like Assaf's definitely capitalizing on that point with SFR, and the same thing here with multifamily. There's no doubt about it.
Thanks. So Aaron, just adding that, which sectors, apartments, industrial, retail, office look safest for family offices today? I think we've heard some about that already.
Yeah, for us, we're solving for really the affordable housing crisis. That's why our focus primarily on 98% of our properties are old 80s, 90s, 70s vintage, some historical assets built in the 20s and 40s, although I'm buying less of that today just because they're a bloody nightmare to service with different things that break here and there. But for us today, we're focused on markets where there's a lack of affordable housing, where there's no land left to build. So you have high barriers to entry with great economics and strong jobs. In these areas, we're not really disrupted by new construction. In fact, it only complements workforce housing because the delta between our rents and new construction is about $1,000. So the more they build, or in some cases overdevelop, the greater it complements the markets that we're in. And we're seeing more and more of that today with a lot of construction going on throughout Florida. And that's part of why we pivoted to our backyard. We live in Bell Harbor, so we're focused on where we live. We don't buy property unless we have a family member living on the ground that is about a 2-hour drive away. I know some people think it's nuts in a world of AI. How can you? You should buy in any state. But between about 4 or 5 of our companies, everything we do is in-house. Acquisitions, management, construction, even the software we use, from A to Z, unless it's a new roof. That's something we're trying to get licensed in now. But having complete control over your operation and understanding your markets, which should be your backyard. So for us, the opportunity is in what we know best, and that's our space of multifamily. But there will come a point in time probably where my kids, or maybe even our generation, will get into other sectors, and that's something we're studying now before we actually make a move.
Great, thanks. So this also came up, Paul, for New York, what are your thoughts on repositioning office buildings or converting them to housing?
I think it's a great idea. I mean, we've seen a lot of the older buildings which become obsolete, and therefore it's a great reuse of well-located old office buildings to have a new life. These buildings are phenomenal. They've got a lot of them downtown. We've tried and tried and tried for the Fly Down area to become vibrant. Hopefully this time around it will become vibrant. We have now, the Whole Foods down there. All the chains are down there, so hopefully it will be here to stay. But there's lots of new converted buildings downtown coming online, which I think is just wonderful. It's a great use of obsolete space to be able to convert these buildings. Not all buildings, however, are convertible. That is the biggest problem, where we find some of the older buildings have air and light issues. So we just have to hold on to those until they can be assembled, and then a new building be erected from there.
Thank you.
I would just add, I think one thing on the conversion side, since playing some of that, is the operational intensity of converting an office building to multifamily is incredibly difficult. The operational risk, the construction risk is insane.
It's details. It's all in the details.
It's all in the details, but that's where, again, you need to find really, really high quality operators, not a syndicator who's saying, I got a great deal, we're going to buy an office building and convert it to multi. Third party management.
The right operator and the right building is what you need. So yeah.
But there are so many of those people around today that say, oh, we have to buy something, and they have absolutely no experience, and they're going to fail, and it makes the industry look bad.
Agreed.
Yeah, many of the players I mentioned earlier, handful of them are locked up in upstate New York. How do things like this happen? It's very simple, where people get excited about these great opportunities and they just wing it. And during 2020, as you mentioned, everyone mentioned here, any group can be funded on a brilliant performa, and many of those performas have gone to hell. And it's scary to hear the stories that are coming out of the East Coast that I've seen, and it's tragic. But thank God, when you surround yourself by the right people, the right families, and you co-invest and you get to know them, you get to know the people you're going to do business with before you get in bed. That's vital. And with the families that we co-invest with, we go out to dinner. We invite some of them over on Sabbath. We sit with them through the week. There's many meetings before there's any thought to wire funds, and we come and see the operation. Vice versa, we invite them to see our team, and that all goes to the point of we're not big third-party believers, and I think that's an advantage.
I'm scratching my head though. We mentioned earlier, there's a lot of young, up-and-coming investors, right? They're paying such a large amount of money for these buildings, but with no experience. Who is funding their equity?
So that's a great question. A lot of that, I have many friends in the nursing home businesses and assisted living that have done a lot of that funding, but many of those guys have actually taken over the projects today, with the LPs voting out the GP. So today, I don't think there's any, drunk money really left out there. So many people have been burnt by these experiences that we're speaking of. It's really important to get to know who you're doing business with. And I will reiterate that many times over.
Since you're all in disparate geographical areas, can you talk about the regulatory environments for each one of you and what you consider to be favorable regulatory versus unfavorable?
Yeah, I think one of the things that we do when we underwrite any hotel to multifamily transition or going to adjacent markets on the SFR space is really understanding the zoning code and what the politics of the day are. Generally, zoning is extremely local. I know there's an initiative on the federal government to sort of streamline zoning code. I think that's going to unfortunately fail. You just need to know what you're getting involved with. You're not going to change anybody's idea. If they think it's bad, it's going to be bad. Don't buy the deal. You're not changing anybody. As an outsider, you're not changing anybody's idea. The biggest concern that I have is short-sightedness on the part of politicians around creating a sugar high for renters today. That's going to be a disaster in the future. I think inflation in the 30s on housing stock is going to be extremely high. It's going to be great for us as operators. It's going to be terrible for the renters because the lack of capital investment and rent stabilized in major markets is going to shrink the supply. And although we have population growth that's slowed this year because of some of the immigration policies, that's not staying forever. And at some point when population growth starts picking back up in the United States, there's going to be a lack of supply between rent-regulated units offline, difficult capital markets that prevented supply from coming online, and we're just going to have a very significant housing crisis. Right.
Maybe we can ask Steve, since he's in California, which is a lovely regulatory.
Steve, what about the regulations that you're looking at there?
I'm sorry, could you repeat that question?
Marty was asking about regulations that you face and how that's impacting.
Wow, that's a long question. I will tell you, one of the most fascinating experiences I've gone through in my short career was what we underwent over the last 12 months in Texas as a result of what's known as HFC. Some of you who have invested in multifamily in Texas are probably aware of it, but it's effectively a way that you could avoid payment of 90% of your property taxes. Well, that legislation had been on the books for an extended period of time, and earlier this year, it was effectively overturned. The net effect of that, though, is that somebody took a loophole and exploited the crap out of it, and then they taught the market how to exploit it. And that ultimately has cost, I'm going to say, hundreds of millions of dollars, both in cost and lack of valuation, simply because we tried to take something that's legislation that was on the books and exploit it. We found a loophole. We tried to make the most of that from a return on ROI perspective, and it blew up in our faces. So look, from a capital perspective, I'm just cautious around legislation, extraordinarily cautious around it. I know that's not a great answer to your question, but it's such a real and very recent experiment that anybody who invested in multifamily in Texas is deeply aware of. That seems like a good topic.
Thank you.
Yep.
Yeah, I mean, well, the thing is, you can do as much due diligence as you like, but sometimes the law changes. For example, in New York City, under the Bellagio administration, lots of people's bought, rent stabilized buildings, thinking that they could, increase the rents as the tenants moved out. That became not happening. So people bought all these buildings, and all these people now are just sitting with these buildings, and they can't increase their rents per their business plan.
Oh, yeah, it used to be a great whole cash.
Well, you used to go through a building and say, listen, this is rent stabilized or rent stabilized, and what's used to do analysis, what our age they are, what's the probability of them leaving. And these people used to buy buildings like this. Then it changed. Their business went down the toilet overnight. And you see today, all those buildings are being sold for cents on the dollar, but the very people they're trying to help, they're actually hurting, because landlords cannot afford to keep the maintenance. If you want, yeah.
Talking about making money here.
But the thing is that sometimes you can do all the diligence you want, but a law can change right in front of you.
He's making a very good point. I want to add to that. I never thought of my wildest dreams I'd live in New York or Miami. It was never part of the plan until, our governor in California started basically editing laws of real estate. The latest one is a mansion tax on multifamily, which is pretty unbelievable. It's a 5% penalty if you sell your assets. So run the numbers on a $50 million deal. For real estate families and landlords that are trying to leave the state of California, we're being penalized. We had
The house is worth $5 million or more, and you sell it for more than $5 million.
But we have that here in New York.
this tax,
It's been out for a long time. We've got mansion tax.
this mansion tax was designed for mansions, single family estates. Now it's on multifamily. So the hypocrisy of the title itself
on
is
commercial.
this is on multifamily today. Yes. So we got up and we pivoted during COVID, and we were having a meeting in Century City. Our family office is in the Watt Plaza Towers, which today is like 53% occupied. It's really sad to see, but light bulb went off in my head. I'm like, we're saying Farsi Baba. I said, Dad, we're moving to Bell Harbor. Out of your mind, you're not going anywhere. Everyone's staying here. The portfolio's here. I said, no, this is what has to be done, because you see government intervention into free market. Yeah. And that's a big problem. If you're pursuing the American dream and you're trying to build a family and build an enterprise, and you suddenly have government intervention by stopping tenants from paying rent, but yet they would show up to the buildings with brand new Benzes and Beamers, but give you the fly for paying the rent. It was unbelievable behavior. And that's why we got up and left. I'm not saying we're not buying at all in California. There's one or two areas we still are, but for the most part, we've pivoted for the time being to other areas and literally got up and moved.
Thanks. Well,
Maybe 2 minutes, actually.
2 minutes. All right. Well, let's go to looking over the horizon. So, Paul, for New York real estate, where do you see the most durable long-term value?
Office buildings. I think that it's a lot of changes in the work environment. COVID's been and gone. We're now getting to normal, where many companies are now thinking about coming back to the office. May not be full time. It may be 3 or 4 days a week, but most people are letting their employees have 1 or 2 days working from home. So the average tenant, let's say, instead of being 10,000 square feet, it's going to be 7,500 to 8,000 square feet. It's what's great about it is that for the employees themselves, up at lower middle management, it's given them a lifestyle which they never had before COVID. And so consequently, we're also seeing that people do not want long-term leases anymore. The small tenants want to have the flexibility to be able to move when they wish to leave. I mean, large law firms, large companies have to have long-term leases, but those people who are 10,000 square feet and below are now looking for lower for less term leases, which is good for us as a landlord. But I think the office space in New York is definitely going to be a place to be.
So Assaf, how do you see travel patterns and consumer demand shaping hospitality investment opportunities in 26 and beyond?
Yeah, look, I think everybody can attest, like the consumer strapped, right? So there's the haves. If you're on the luxury side, you got a Bitcoin, or Ethereum, or stocks, you're doing great. And if you're anybody else who's not in that bucket, you've been struggling for the better part of 3 years. I don't really see that changing much until there's a real significant break in interest rates, because I think most of those individuals are cash strapped, and their companies that they're working for are cash strapped. I think it's gonna be tough. I think travel is gonna be tough. Again, ex luxury, but I think going out into 28, 29, 30, there has been besides multifamily, there's been very little hospitality room units brought online. And you have individuals like myself who are taking them offline for alternative purposes. So, I think that if you find the right operators who have the right business plan, looking out to the back half of the decade and into 2030s, there's going to be a ton of alpha to be created on the hospitality side.
Finish your comments? Or?
30 seconds.
Yeah, Aaron, Steve, do you guys have a final comment? Yeah.
I would close by saying I think we're living in very opportunistic times, and where rates are going right now, we're borrowing around 5% or so. That's a healthy number if you look at the overall historical average. I would like to see a couple rate cuts. It would definitely help things, but you never want to be too opportunistic. I think that's when it really comes down to what's your basis in a deal. What's the job market like around you? Is this a high barrier to entry market or not? Because it really comes down to basic fundamentals, and the timing is key. So you can make money in any environment, really, if you have, the proper interest rate, the going in cap rate, and your basic fundamentals on the economics. So in both cycles we buy. It just really depends on the individual deal and the story. And so I remain very opportunistic. That's our mindset today.
Yeah, I would. First off, I love that.
Sorry, I'm getting pulled here. I apologize. Wanted to give you a final. Let's see if you have a final comment. Okay, go ahead,
Oh,
Steve.
thank you, Marty. Economic cycles are inevitable. We're at the tail end of the longest bull run in U.S. history. So we are going to be facing an inevitable downturn. There's two ways to look at it: as a challenge or a tragedy, or as an opportunity. Einstein said, in the midst of every great crisis lies great opportunity. So if you embrace that notion and stick to the fundamentals that Aaron talked about earlier, which is know your investment plan and execute it, we think we're looking at generational opportunities. So thank you again for your time and the ability to be on this panel. It's been a pleasure.
All right. So I'm not sure how we have a lot of international people here in the audience, and probably a lot of people saw this get together in China a week or two ago, and we had China and Russia and all kinds of other countries together, and so in a military display by China. So we're lucky enough to have Tom Barron here, who is from Pacific New Zealand. And he's an economist, macro guy who looks at these things. He's going to talk a little bit about what's going on there and strategies for adapting to what's happening out in Asia Pacific.